All right, welcome to um the fifth day of this training. All right, so today we are going to be talking about liquidity. We have still been on the liquidity series for quite some time. Yesterday we discussed internal and external liquidity. Right, we talk about the concept of liquidity. Right, so today we are still going to continue on that liquidity topic. Right, just to do a brief recap. So yesterday I talked about when when liquidity is considered internal and when liquidity is considered external. And then I also try to let you guys know um, the kind of liquidity you should pay attention to. I think I say that whenever the market is creating internal liquidity, like we have external liquidity now created, and then price creates internal liquidity along the range, and then makes a new high. And let you guys know that um this extreme region is what we call external liquidity, this extreme low and this high, so to refer to as the external liquidity. And then I say that once price takes out external liquidity, it begins to target this external liquidity here. So once price takes out this external liquidity, the next target becomes what? The internal liquidity. So price moves from internal to external to internal to external to internal. So price moved from, after taking out external liquidity, the next thing price is going to do is what? To target what is internal liquidity, right? And I told you guys yesterday that um the last internal liquidity is where price usually reverses from. That means price has very high tendency to reverse after taking out what? This last liquidity, right? So you have to pay attention to that. Now, let me just add some cherry on top of your pie. I know I gave you guys some pie yesterday. So let me just put some cherry on it, right? What I mean is that let me make it more interesting, or let me make it more beneficial to you. Now, apart from the idea of last liquidity, there's something that we call mitigation, right? Mitigation helps you to know the area where price is likely going to reject from. So mitigation helps you to know where price is headed or where price is likely going to reverse from. Now, what is mitigation? Mitigation simply refers to the act of price tapping into an area. So now, how do you know an area has been mitigated, right? Let me just step it down here. How do you know an area has been mitigated? How do you tell that an area has been mitigated, right? Number one, you know an area of mitigation by two simple tests. Number one, there's always usually an imbalance. Right? Usually an imbalance, and then there's usually what? It's usually untapped. So these are the two ways you know if an area has been mitigated, right? It has been untapped. What do I mean? You know, let's look at this market for example now. Let's look at this. Okay, let's look at this. So let's also see life example. Now, if you look at this chart very carefully, we'll see that okay, we have this is another block, right? Now, can you see how price came back into that area? Now, share price came back, pushed into this area. That means what? This area has been mitigated, right? So when this area is mitigated, what happens? It creates another area, right? It creates another area. Now, where's the new area here? Obviously, this last push up, right? So you can see our price came again, pushed into that area to mitigate that area again, right? So you can see our price pushed into this area. That's what's called mitigation. So now price has gone down. Now, where is the new area to be mitigated? We have this new other block. Price again came back, pushed into it, mitigated it. So now where is the area that has not been mitigated? Of course, you can see it obviously that this area here, okay, you can see obviously how price still came back, mitigated this area again. So now where is the area that has not been mitigated? It's very, very obvious, right? It should be very, very obvious to you right now. So you have to look for the area where price has not tapped into and where there's some kind of imbalance, right? So if you look very carefully, you will see that this last push up here is the last push up here. So this last push up here has not been mitigated. So you can see our price has not happened to this area yet. So this is the last push up before what this drop down, and you see that price has not been able to come back or tap into this. So what we refer to as mitigation. This area has not been mitigated, right? So this area will need mitigation in the nearest future, right? And then you always have to use the exact candle, right, before the whole imbalance stuff. So this is the last candle before the whole imbalance, right? This one here. So now this guy becomes what? The unmitigated candle. So in the future, price is likely going to come back to tap into that point, right? So always pay attention to the areas that have not been mitigated. And of course, price don't always come the immediate. That means in the future, right? In the future, you might see price, you might see price, you know, treat this point as as internal liquidity, treat here what as internal liquidity, or to do what? To come back into this area. So you always have to pay attention to the most extreme point where price has not mitigated. So if you are going from the top to the bottom, this is the highest point you can see here. And then this is the lowest point, right? This is the lowest point here, right? So you have to always pay attention to the ones that have the extreme ones. That means at the highest point, which area has not been mitigated. So you can see obviously this one, right? And then if you look very carefully also, we also have another area which hasn't been mitigated. Of course, you can see that this this last push up as well hasn't been mitigated. Why? Because price did not tap into it. And of course, you have to use the very last candle. Right? This is a whole This is the last push before it was this last drop down, which hasn't mitigated. But of course, you can pick the very last candle, which is what? This small candle here, right? This is the last candle before the imbalance, right? So to be precise, you can pick this area. But don't forget that this is a whole area, right? I was thinking about other flows. So you can just make it to be easy for yourself. You can pick from here down to this point, right? From this high down to that last candle so that you don't miss out, right? So this is what we mean by mitigation. Price coming back to tap into an area that has not been tapped before, right? So that's what we mean by mitigation. So now we have understood all that. We cannot go back to this. So now, like I was saying, after price takes out an inducement, you want to always pay attention to the part where the area where price has not mitigated. Those are the areas where price will likely reject from, right? So that's basically what you want to be doing, right? So that is it. So if you look at this candle here, you can see this inducement. This was the last inducement I can find here, right? And then what do you have? You have what this last push down, right? And if you go to a 1 hour chart, you'll see that this is actually one candle, right? It's actually one candle, or let's say two consecutive candles, right? So you can see how this last area, this last push down was what mitigated, right? By this push to the downside, right? So we have to always pay attention to that. So sometimes it's not always one candle, it could be two candles, it could be three candles, right? But always pay attention to the last point where price, saw a push to the opposite direction. So after this push down, we saw a move to the opposite direction. I mean, this area had not been mitigated. So price came back to mitigate it and then was pushed above what this previous high, right? So those areas where price has not happened to, so you always pay attention to whenever you're considering what your liquidity, all right? So that is by the way. Now let's talk about the topic of today. Please, if you have not watched the previous video from day one to day five, please do want to go through those videos because those videos will give you perspective um and a better understanding to what we're doing here today. So do want to like and subscribe to this channel so that you can get notifications when our video drops, right? So do want to like, subscribe, and put the notification bell on so that you can be able to get access to what we are doing. And of course, if you have not followed me on Twitter, do want to follow me on Twitter with the link on my profile, right? So let's get to the matter. So now today we're talking about what? Let's talk about previous day high. Let's say previous candle high. All right. So I told you guys that we have three of them. So that is previous candle high and low. So we have previous day high. So let's all right. So previous candle high or low. So under this, I told you guys we have various ones. We have we usually use very few ones. Daily, weekly, monthly, and then yearly. So these are the four we usually use, right, to determine the candle high and low to use. And then sometimes we can also use 4 hour, right? I think the 4 hour should be the lowest because 4 hour gives you some move, right? You want to use bigger time frame candles because those candles give you a bigger portion of a move, right? So now, what do we mean by this? Now, there's liquidity resting at the high and low of each candle, right? Because let's look at this. Now, if you look at the daily charts carefully, you notice that whenever price, you know, wanted to give a major reversal, right? We saw price take out a previous daily low, right? So watch carefully. From this buy that happened there, you can see what do you see here? Let us pay attention from this point here. So can you see that this was the low of this candle? So this was the low of this candle. Sell price took it out and then what happened was this impulsive buy started. Now, I'm not using this candle in between because this candle is an inside bar. So I'm not paying attention to this candle in between because this is an inside bar candle. You pay attention to the candle at the extreme. So this is the bigger candle, this is the high of the candle, and that is the low of the candle. So this candle is inside this candle. That means that inside bar candle. So you don't use inside bar candles to determine high and low. You use the original candle that is not inside another one. So if a candle is inside the previous one, we don't use the inside bar candles, right? So you can see how market took at the low and was you can see a positive buy. Look what happened there again. Same thing as well. Although this is an inside buy candle, but you can see how price took out the low and then what happened? Bought impulsively. Right. And then look at another thing here. Look at it here. Price took out this low, bought impulsively. As far as took out this high, what happens? It dropping down. Can you see? So you got all these moves. So it tells you something. Look at this. Look at how price took out this candle high. What happened next? You can see the market started dropping like hot potato. Look at another one here. Took out candles high. What happened next? Started dropping. So the price take out candle high or low, it usually gives what a good a good reason to do or to go high, go lower or higher. Look at this. Especially look at the previous candle lower happened. So this is a positive buy. So you have to always consider the trend that you're in. But look at this one here. So look at this previous candle low. Can you see a positive buy? So look at just pay attention to how this has been repeating. So let's look at this candle low. You can see how the market pushed up next. What happened again? Let's look at the candle low again. You can see this push up to the upside. Right. So most times the previous candle high or low on the daily chart fuels a move. Look at this. Price look at this candle's high. What happened? Drop. Look at this. Look at this example here. Unity price look at this previous candle high, this daily high. What happened? You can see how the market was dropped impulsively. Right? And you can always use this candle. So previous daily high does not refer to the candle of yesterday. It's going to refer to about 3 days. So when I say previous daily high, it's not only yesterday or the candle before it. It could be like the 2 or 3 candles before it. So you can see that this was a candle. You use the most pronounced candle. So you can see how the market was pushed above this previous daily high. What happened? It's dropping impulsively. You can see also, you can also judge by here. You can see how price look at this previous candle high. You can see how it dropped impulsively. You can see how this is repeats. Look at it. As far as look at this previous daily high, you can see how it dropped. Right, so you want to always consider the trend. Whenever you're doing this, look at this. As far as look at the previous daily low, can you see this impulsive buy? So those kind of moves are very, very sweet when it's in line with the trend. Right, look at this. Can you see this? The same thing here, right? Price look at it. Tap into this area here, this last push down, what happened? We started seeing a very impulsive buy. Right, so this is how the market actually books. So that's how the market actually books, right? It books that way. So now, how do we use this to our advantage? Now I've understood this whole concept, right? Now we use daily high. Look at this. So we use daily high. Look at this. As price look at daily low, you can see how price is reversing, right? Can you see it? I mean, price look at this. Reversing was a reversal, right? Look at this big sell that happened. Price first of all took out this daily high here. But price look at this high here. What happened next? First thing was this impulsive drop at the downside. All right, so now What is the significance of this? We'll start with daily charts, right? This also applies to weekly and monthly and yearly charts and even 4 hours sometimes. So now, what is the significance of this? Number one, you have to consider the trend of the markets. That means you have to consider the trend. If the trend is bullish, right? Let's say the market is bullish. That means um, when the market is bullish, when price takes out the low, it's a fuel for what? A buys, it fuels buys. So when the price takes out lows, right? So if you're bullish now, right, the market is bullish. When price takes out the previous daily low, that's a fuel for what? A buy, right? So when price takes out the previous candle low, that's a fuel for, look at this. I let's look at the low, what happened? It's a fuel for a buy, right? Look at this again. As well as look at this candle low, can you see a fuel to the buy? So when you're bullish, you want to pay attention to what? Markets taking out the highs, right? No, the lows, sorry. So that is a fuel for your buy, a buy continuations, right? While the high will act as was profit targets. So now what do I mean? So highs act as profit targets. Name this for a bullish example. I say on bullish examples, right? So, the low fuel bias and highs act as targets. So the lows will fuel buys while the highs act as what? Target. That means if you're bullish now, let's go back to this. So as price took out this daily low now, right? We had the price take out this previous candle low, right? This fuel buy while the high of the candle will act as what? A profit target. So these are that targets. So you want to buy into what? That point, right? So the highs act as what? Profit targets, right? That's basically what I mean. So look at this one here. So that's what I mean. So your highs will act as what? Your profit target, right? Profit target. That's how we do it. You use highs. Look at this. As far as look at this low, we're bullish here. Can you see how this fuel they buy? And then what are we targeting? The high of the candle. What is what? This high. So you can see how this buy market dipped into this. That means our fuel for buy is set to what? To take out what? That candle's high. So that's how we do it, right? The same thing occur here. This took our liquidity. Where will be our targets? Obviously, but the candles high, right? That's where we usually use as what the target for after the liquidity has been taken. Now, of course, price doesn't always have to go to the high. Sometimes you can also use what the mid of the candle. I mean, you can divide the candle into two now and use the midpoint as your target. That means you can, if you buy at this low now, you can use by that low now, you can use the midpoint as your half your partial target. That means if you bought after price took out this low, what do? You can target 50% of the current as your partial target. That means you can take partial profit at the midpoint, but overall your target should be what at the higher the current. So that is a very simple approach. So this approach works on the weekly chart. It works on the 4 hour chart. It works on the yearly chart and any chart at all. 3 months charts, right? Let's look at 3 months chart. Let's see if what we are saying is true. So now, what has the method been doing on the monthly chart? So on the monthly, we have been bearish, right? So can you see? Let's also look at the monthly chart. This is very bearish structure, right? This is a 3 months chart, right? Can you see that we are bearish? As price took out this high, what happened? It fueled what is sell to what to take out the low of the candle, and consequently, we take out what this overall low. Now people you might be asking, but sometimes price take out the high but still going high. So what do I do? So now when price take out the high and continue going high, these are the cases where there was you have whenever price takes out the high, right? Pay attention to me now. Someone may ask you now, price can take out the look at this. Now someone can ask me now, sir, but price took out this high now and it continues pushing higher. What can I do in such cases? It's very simple. You have to consider what the structure of the market. So once price take out the high, it doesn't mean you should just sell immediately. You look out for what? Market structure confirmation. And now you can see that this high was a failure swing high, right? So this high was supposed to be taken. Now, I told you guys that when market is bearish, right? The market is bearish, right? And fails to, price fails to go below this low. Now, I told you guys that once price fails to go below this low, it means that this high is not strong enough to make a new low. That means this high might get taken. So whenever you see price doing this, and market fails to make a new low, it means that price might reverse to the other high. So that means this high does not have enough liquidity or enough power to push price to the downside. So that's what happened. The price did not have enough power to push below this low. That means this high was weak. So that if you are trying to sell this, it would have been wise to wait for price to take out that high first. As price took out that high, and then get this previously high. This was actually a confirmation for what yourself, right? I'm giving you guys a good gem there. So always pay attention to that. So now let's just continue watching what happened. Look at that. We are still driving down. What happened there? You can look at another fuel here. As price look at the high, can you see how we had a fuel for itself? Right? So how price fuel to the downside. The same thing happened there. You can see the same thing here. You can see the market fueled. We had liquidity resting here. Price to do that. Then the fuel to push down was ready. Right? The same thing happened there. You can see how price look at this high and then was pushed down. The same thing happened there. Price look at the previous high, push down. So this is a call on repeat. It happens on repeat. It happens on repeat. Right? It happens on repeat. Right. So that is basically what was it. Now, if you look at the 3 months chart, you can see that, um, of course, price has taken out this high, right? But it will be really nice to see price take out this high because I don't think this sell is really ready. Or it would be nice to see price to take out this recent high before pushing down because the last candle closed very bullish. So if for this sort of continue, it will be very, very nice to see price push above this high, taking out liquidity before pushing downward. So that liquidity grab is what usually forwards itself. So for now, you can see that the 3 months chart is not really ready for itself. Want to see price take out the previous particular high. We are taking out this one, yes, but the high of this recent bullish candle will be more it will be a more confirmed move because you can see as price look at the last bullish candle, you can see market is dropping. So I want to see, and you can see the same thing also reversed. Price look at the low, and then we see it was there buying, right? See another one here. Price look at the low and say buying. This was a counter trend move. So for us to really enjoy this sell, let me see price take at that high first before we can really enjoy this sell, right? So for now, I see that GU can still push above this 3 months high, right? It's a very, very good possibility, right? So that is basically what I mean. So this is where I'll be wrapping up for today. It's a very, very simple topic. If you understand the concept of candle liquidity, you're going to really, really make good good trades, right? So I told you guys that you don't just trade that blindly. You have to also consider what I said. You have to consider what you have to consider the terrain of the market. The market is bullish. You want the market to push to take lows and then give you your buys. The market is bearish. You want the market to take highs and give you what your sells, right? So that's basically what you should be doing. You don't just take buys and sells without having a structural bias. And the market must give you that structure bias. Market must be bullish on structural perspective. All right. So that is basically how to do this. So I would like you guys to just go to your chart and then use the 4 hour chart and identify what I just do now. Find the conditions where market was bullish and then price, gave my price took out 4 hour low and went to the high as target. Now, remember what I said? I said something very unique. I said that previous candle liquidity is not only yesterday's candle. It could be 2 candles behind or 3 candles behind, right? So it's not always that it must be the very last candle. I told you, remember that it can be 2 candles behind or 3 candles behind, right? It's not always only the last candle. It could be 2 or 3 candles or even 4 candles behind, right? And that's what a liquidity grab for your buy, right? So that is just basically it. So like this example now, you can see as price took out liquidity here. But it's not the most recent one. So after I took out this one, you can see our market just dropped. So it must not always be that you must wait for this very last one. No. Right. Once I take a liquidity and you have a reason or structure to continue the downside, you can use it, right? So don't forget to like this video, subscribe to the channel, and tomorrow I will see you for more teachings. Right. So have a wonderful day. Cheers and God bless.